We have the guest joining us on the show, Mr. Ramesh Iyer, the MD and Vice Chairman at Mahindra Finance. Mr. Iyer, hi. Thank you so much for making time and speaking with us. I just wanted to begin by understanding that Q1 is seasonally weak, but the growth that you have surpassed has been pretty much okay. It's been lower than what your peers have managed to report, but versus the expectation, it's a bit up out. Can you tell us what is the kind of growth you're targeting for the full year?
So yes, normally, the first and second quarter for the market that we serve are not the best of quarters. Historically, we've seen that, and the third and fourth quarter really catches up. But for the last few quarters, we've been saying that the rural demand is holding up very well. The demand is high, sentiments are positive, all activities are doing well. And I think that's what has resulted into a good growth, good collection, and a good NPA management. And it's not led by any particular product or geography. I think we've seen buoyancy across the country, across products. And of course, there will be some variation within the products in terms of growth is concerned. But I think we're seeing demand holding up for all products. But the pre-owned vehicle seems to be leading the front in terms of the overall growth trajectory is concerned. But we are pretty happy with growth in all products that we have had, including gaining some market share.
Mr. Iyer, morning. Now, your net interest margins have been impacted largely on account of the rise of cost and borrowings. On the one hand, you're focusing on higher yielding pre-owned, and on the other, you've also been onboarding low yielding Primex customers. So, in light of this, how should we see your net interest margins moving?
I think one important thing to note is when we get into the Primex kind of a customer, while they come at a lower yield, they also come at a much lower operating cost and definitely at a much lower credit cost. And you're already seeing some, reduction in our operating cost visible because of these arrangements. So what we lose in yield gets covered through the OPEX drop as well as the credit cost change. But importantly, the pre-owned vehicle comes with a much better yield, and therefore that they contribute to a better NIMs. Yes, definitely, because of a change of liability mix from what we had in the past when they mature and we borrow new money, the new money comes at a new price, and there has been about a 20 bips increase in cost of borrowing that we have seen. But largely the dip that we have seen for ourselves in the NIMs is also caused by the product mix change. Going forward, we have already increased our lending rate by about 20 bips during this quarter, which will start showing in the numbers in the following 2 or 3 quarters. In as far as the better product mix is concerned, and as the pre-owned vehicle number starts to grow, you will start seeing improvement of that. We are confident that from where we are to where we will end the year, one could see a clear movement of NIMs going up by at least about 25-30 basis points for sure.
Fair enough, Mr. Iyer, but your return on asset currently is around 1.4%. If I have it right, your mission 2025 was 2.5%. It's fairly a tall ask. Are you confident about achieving that?
So if you really look at our overall book credit cost or the gross stage 3, is at 4.35%, which is at its lowest. And for the first time in the history of our business, that in the first quarter, the GS3 is actually lower than what we closed for March. So that's a great signal of how the cash flows and the ground is working and where it could lead to. If you look at our last maybe 1.5 years of lending or 18 months plus lending, we see the GS3 numbers are much, much lower. It is kind of in, less than 2% kind of a number. And as the old book starts to run off, you will see the GS3 number settle down much lower than where it is today. It's also important to note that our forward flows are very much under control. We don't see increasing stage 2 happening. We don't flow from stage 2 to stage 3, and that's the reason the absolute GS3 numbers are curtailed at 3,600, 700 crore kind of a number. So putting all this together and then look at the collection efficiency are holding up upward of 94%. I think we are very confident that we only see improvement quarter over quarter as we have seen even in the last 4 quarters.
And Mr. Iyer, given that the news recently is that the parent M&M has bought stake in RBL Bank, just wondering from your end, is there some sort of a bigger strategy in the works here? Could you shed some light as to what the overall rationale and game plan is?
I mean, I'm not aware of what the rationale or how they think about it. It's an investment from the parent, as you said, and therefore I would refrain from any comment on this. Please, I should be excused.
Okay, Mr. Iyer, would have loved to get a bit more clarity as far as that M&M and RBL transaction is concerned, but nonetheless, we'll wait for the right time to hear more on that. Thank you so much for joining ET Now today.